Dear friends, we don't have to go far. Recently, we've talked to you in several videos about the various economic challenges facing Europe. These issues are causing Europe to lag significantly behind the United States, for example. You might remember this chart that we've shared with you before. The gap, as you can see, is growing wider. And now, to top it all off, we have news like this. The US economy is expected to widen its lead over Europe, according to the IMF. But it's not just about the economy. Productivity and employment are also at play. The stock markets in the old continent have been, and continue to be, a faithful reflection of this situation. Of course, as you can imagine, this is not a coincidence. The earnings per share growth of companies in the S&P 500 has been around 13% over the last decade, practically double the EPS growth of European companies. But the real issue is the significant valuation differences between them. In fact, things have gotten to the point where even a single company like Nvidia is worth more than all the companies in the stock exchanges of countries like France or Germany combined. And bear in mind that giants like SAP, Siemens, Mercedes, BMW, and DHL, among others, are listed on the German stock market. Yet, Nvidia alone, with just about 30,000 employees, is much more valuable than the nearly 800 companies listed in France and the 500 in Germany. The performance of European stock markets has been so poor that their weight in international financial markets keeps declining, even more so than the shrinking of their own economies. The question is, could this be a sign that Europe is becoming a stock market opportunity? Will the markets of the old continent close their gap with the US stock market? Right now, we're going to try to answer these and other questions. Hello to all the community of Finance for All. Welcome to another video. It's no secret that the European economy isn't doing particularly well. After the pandemic and the impact of the war in Ukraine, the gap between the United States and Europe has widened significantly. The North American powerhouse today has a GDP nearly 99% higher than pre-pandemic levels, while in Europe, the increase has been just 3.4%. We're talking about a difference of more than 5 percentage points in a very short time, which is largely explained by this. US productivity has been growing above Europe's for 20 years, two parallel realities with many nuances. Productivity in the US has grown 8.4% in the last 20 years, compared to just over 1% in Europe. To make matters worse, 2024 might mark a turning point in European history. Dear friends, this year could mark the beginning of the decline in Europe's population. We're talking about the only continent that is already losing working-age inhabitants, and in 2024, we might see this decline begin, which, of course, is terrible news for economic activity and business performance. Think about it, a shrinking working-age population is a serious problem. With fewer people working and starting businesses, there will be fewer opportunities for large companies to emerge that can drive national economies. Many infrastructures and services will operate at higher rates, simply because they will have fewer customers. And of course, sooner or later, businesses will face lower consumption levels, and public finances will suffer. The decline in population is not good news. In other words, Europe has entered a sort of paralysis that is increasingly distancing it from the rest of the world. A good example of this stark difference is the enormous boom in American tourists flocking to southern Europe. When these tourists arrive in countries like Portugal, Spain, Greece, or Italy, they feel like millionaires. The price difference compared to their local markets is simply staggering. What would be considered a fairly ordinary vacation in their home country can become a luxurious experience in this region of Europe. As a result, more and more Americans are arriving, and they are spending much more. Do you know the outcome of this trend? Just look at what's happening in Portugal. In this country, as you can imagine, tourism is an absolutely key industry. Well, Americans have just surpassed Spaniards as the largest group of foreign tourists. Thanks to this, Portugal's GDP grew by nearly 8% between 2019 and 2024, compared to less than 1% in Germany, according to data from the International Monetary Fund. But why are we talking about tourism? Because, friends, sometimes things may not be going entirely well, but that doesn't mean all strengths have suddenly disappeared. Europe still has many competitive advantages. For example, although Europeans make up only 5% of the world's population, the European Union receives approximately 1 out of every 3 tourist dollars spent globally on international travel. And friends, keep one thing in mind: we can talk about the higher or lower value added or productivity levels of this industry, but one thing is clear: leisure and tourism are two industries that will likely see significant growth in the coming years. This is something well understood in Spain, among other reasons, because the country has a vast tourism infrastructure and, according to some estimates, this sector is responsible for almost 2/3 of all national economic growth. And things could get even better. Binter predicts a potential 17.4% growth for the Spanish stock market by 2025, approaching 13,000 points. But we shouldn't only talk about tourism. If we look at the industrial sector, something similar could be said about the heart of Europe. Sometimes we forget, but between France, northern Italy, Germany, and Poland, we have one of the largest industrial regions in the world, one of the largest and also one of the most competitive. But even more, look closely at this chart. As you can see, for the first time in several quarters, Europe's growth has not only rebounded, but has also come close to that of the United States. And the forecasts for the coming quarters may be better than expected. We believe that the combination of a strong labor market, comparatively strong wage increases, and lower inflation compared to last year could lead to even better outcomes. Ultimately, this could lead to a moderate recovery in consumer spending over the next few quarters. In other words, things might be bad, but not as bad as the market suggests. And precisely for that reason, because Europe still has certain competitive advantages and because there's a significant divergence between the markets and the economy, the stock market punishment may have gone too far. The difference in multiples between the United States on one hand, and the United Kingdom, France, Germany, or Spain on the other, may have stretched too far. And be careful, because if history tells us anything, it's that sometimes when this happens, we might be looking at a great opportunity. But hold on, because not everything is so clear. Europe has economic problems and also many political uncertainties. And we're not just talking about the war in Ukraine or energy costs, but also about the massive political polarization that could have many consequences. Think about the debacle of Macron's party in the last French legislative elections, the government change in the United Kingdom, or the almost unrecoverable fall in popularity of Scholz in Germany. And that's just mentioning the 3 largest economies of the old continent. And friends, if there's one thing markets don't like, it's instability and uncertainty. But I insist, despite everything, the vastly different performance of the US and European stock markets, or more specifically, the valuation gap between US tech companies and those of the old continent, may have gone too far. We're talking about European stocks trading at a price-to-earnings ratio of 14 times, compared to around 21 times in the United States, with expected earnings growth of 5 to 6%. This represents a 50% discount. Isn't that a bit much? So, what does this mean? It means we need to stay alert. But now, dear friends, we've reached the end. The question is for you: do you think European stocks will manage to close their valuation gap with US stocks? Do you believe it's worth investing in Europe? What scenario do you foresee in 3, 4, or 5 years? As always, leave your thoughts in the comments, and let's start a discussion. And of course, don't forget to like this video and subscribe.